Hey everyone, it's Alissa Coram here. Now, in Mark Minervini's latest appearance on IBD Live, he gave the audience a trading psychology masterclass. Here's part of the conversation.
Trading is about making more than you risk and doing it over and over to get to your goal. It has nothing to do with getting highs and lows. And it
Right.
certainly has nothing to do with Monday morning quarterbacking and saying, oh, if I had only held. If you're going to look at the stocks afterwards and think that the result justifies the means and that you shouldn't have sold because the stock went higher, you're you're in for a big surprise. You're in for a rude awakening, and that's going to dictate your emotions and it's going to dictate your trading. So I learned a long time ago what trading is about, what the goal is. The goal is to make money. It's to make more than I risk and to do it over and over and over and compound a return. And if I'm not looking at just like, someone's richer than me. I'm happy for them, as long as I'm where I want to be,
Right.
right? If you're worth $100 million, are you upset that someone's worth $1 billion? So I use that logic that, I accomplished my goal. If I
Right.
sold Bitcoin right now and I made 40% on my money in 15 days and I risked, let's call it 8%, if I do that over and over, you do that over and over, you're going to be very wealthy. You're going to be very wealthy. You won't have to worry about getting Bitcoin to go up to 100,000 if you do that over and over. So that's the real. My goal is to make more than I risk and do it as many times as I can over and over and over. And so I don't even think about that. Like it says, I have no most of the time, I don't even know if that happens. I'm not looking way later on and seeing, oh, I forget that I even bought that stock at that particular point. So it just
Right.
doesn't even, yeah, it has no place in my psychology
Mhm.
whatsoever.
Because I think the alternative is it actually may backfire because if you think, oh, I got to keep holding it so that way I don't sell too soon. I would much rather sell too early than too late.
Absolutely.
So those are your
Absolutely.
choices.
Yeah. Yeah. If
Seems
you're
like a
not,
pretty
if you're
easy
not
one.
selling early, you're selling late. That's Yeah, because
Yeah.
you're never going to sell perfect. Very seldom are you ever. If you're counting on selling perfect and later on feeling good about the trade, if you think you're going to feel good about a trade afterwards, again, you haven't been trading long enough. You don't understand. And here's the psychology. You buy a stock, right? It goes down, and you take a loss, right? You take a loss. Let's say 5%. Let's say you lost $2,000. The next day it gaps up. It goes up, and you would have made $25,000 if you held. How do you feel? You feel terrible, right? I
Mhm.
I should have held it. Oh my God, I got scared out. I got shaken out. You feel terrible. So let's take the same exact scenario. You lose $2,000 today. Tomorrow it gaps down, and you would have lost $25,000. How do you feel now?
Right.
Now you feel great. Same exact loss.
Yeah.
Nothing changed.
Right.
Nothing changed except Monday morning quarterbacking it and looking at the result changes all your emotions change. See, but that we don't trade after the fact.
Mhm.
We trade in real time. You have to manage risk in real time. Hindsight it doesn't mean anything. We're not trading in hindsight. We're trading in real time. So when you look in hindsight, it's an illusion. It's what they call fugazi. It's a fugazi. It's a fake. It's not has no place in your psychology. So don't even consider it. Now that doesn't mean you shouldn't do post analysis and
Right.
see, hey, am I habitually selling too early? Like, am I leaving money on the table without taking much more risk? Maybe you're always selling too soon, and stocks are not giving you any reason to sell. They're not extended. They're not doing anything wrong. So that is a different story. That doesn't mean you don't do post analysis and you go, but it does mean that just because you sold the stock and it turned back up, stock goes down today on earnings and it gets clobbered and it's down 15%, blows to your stop, you get knocked out. Tomorrow it gaps up on a takeover report.
Yeah.
Does
Palo
that
Alto may
mean
be a good example. I'm
does
sure there
that
are
mean that
folks who
you
felt,
did a bad thing, that you made a
yeah,
mistake? No, no, because you could only deal with what's happening in real time. You're playing poker. The cards come out of the deck. You're making your decision on that current hand. You fold a hand, you fold a pair of sixes. Now on the river, a six comes out and you would have won. The odds were the odds at the time. That card coming out, no one could have known that. So we're trading with probabilities, and you've got to learn to train your brain to focus on what's important. What is the actual goal? The goal is to make money.
And that's where, I mean, Mark, I'm
Great
sure
reminder.
the benefit that you have in kind of not getting torn up by those stocks that go up is you're looking at your equity curve. You know, you're looking at the culmination of all your decisions, not just that one. And it's really about your equity curve, you know, at the end of the day. And to your point about post analysis, it's not necessarily about one stock, it's about your process. You know, that's what the purpose of post analysis is for, is to make sure that there's not a flaw in your process, not that you made a mistake on a single trade, you know, and you could have gotten more out of it. It's, as you said, what are your habits, and what is your process?
What are your tendencies? What are your tendencies? Like even in poker. I mean, poker, there's a saying, or a good players, when they read other players, they don't look specifically how they play any one hand. They try to get a read of their tendencies, and then you play a player's tendencies. It's the same thing in the market. And you got to look at what are your tendencies? What are the things you're doing well? What are the things that you're doing poorly? And improve the things that you're doing poorly. But the bottom line is that I make mistakes every day. I've been doing this for 41 years, every day of my life. I've been sitting in front of a screen watching tickers blink for 41 years. And still, I make thousands of mistakes and I never get it perfect, almost never. So it's a fruitless chase.
Right. Perfection is not a requirement for success by any means.
The real problem is, though, is that you don't trade perfect. Your goal is to perfectly trade your plan and then to improve your plan. But people are so obsessed with the upside and they're not looking at the risk. Risk first is my two most important words with trading. Risk first. That's all I worry about is the risk. That's all I'm concerned with is the risk. Risk. Larry Height, legend. He's one of my mentors, very good friend of mine. I talk to him all the time. All we ever talk about is risk. Managing risk, techniques for managing risk and managing volatility. That is, we don't ever talk about upside. If you manage the risk and you put yourself in a position where eventually you're going to get fortunate, call it lucky, whatever you want to call it, educated guesses, and you're in that place where there's an occasional big winner and you're managing the downside, well, then you're managing that risk reward relationship. But you can't, the upside's is going to do what it does. The downside, though, is the only thing that you really have control over. That's the only part. Once you buy a stock, it goes into the hands of the stock gods. What it does, you don't have any control. You only have control of how much you buy, what you buy, when you buy and sell. That's it. Everything else, you don't have any control. So at that point, the only thing you're in control of is how much risk, because you don't even have a profit yet, right? The stock, you just bought the stock today at $20. You have no profit. The only thing that you have control over is managing the downside. So you have to make best use of what you control, and the things that you don't control. This is the key to my success, is the things that I don't control, I don't rely upon. I make it so my reliance doesn't rely too heavily upon the things that I don't control, and I utilize the things that I do control and I rely upon that. That's how you build a strategy.
Now, I really hope you enjoyed that clip from IBD Live, and I want to hear from you. What are some of the things that you think you should be working on when it comes to trading psychology? Sound off in the comments below. And be sure to subscribe to my channel so you can stay up to date when I drop new videos. Thanks so much for watching, and I'll see you next time.